Hi, so Forex, welcome to this live webinar where today we're going to look at our interest regarding, do you need a UK tax return? UK tax return is a funny thing. If you're in the UK, you don't always need a UK tax return. If you're in an expat living and working abroad, you don't necessarily need a UK tax return. If you're an expat living in the UK, you don't necessarily need a tax return. There's horses for courses, and it's an important time. We're coming up to the deadline at the end of October each year. It's the time that a UK tax return could be submitted by paper. It can't be submitted for an expat with non-resident earnings online using the HMRC. It has to be done online in a separate way. Proact are very good at helping you at that. You can contact us at proactpartnership.com at any time. You can subscribe to the YouTube channel and see if we can find out help and guidance using our online chat service. And we've got many other ways that we can help people. There's always more information if you go along to our website at proactpartnership.com. So what we're looking at today is and we're looking into a series where we're considering residency and how residency for expats has been amended post-Brexit. There's been a lot of turmoil in the world and in the UK in the last couple of years. Is that because of Brexit, or is Brexit a reaction to the turmoil that's going on in the world? That's what we're examining, but in the residency series. But for this particular episode here, we're focusing directly on whether an expat needs a UK tax return. That's prettier. I've also got a little leaflet here, which I could have put up for you to see, but we'll just leave it as it is. Okay, so moving on to the next stage, let's consider that whether you need that UK tax return or not as an expat. Now, in the when we look at it from our residency series point of view, let's consider that. If you're a resident or a non-resident, you may or you may not still need to do a tax return. So just because you are resident in the UK doesn't mean you need to do a UK tax return. Just because you're not resident doesn't mean you need to do a UK tax return. If you're resident, you're not necessarily a tax resident. And we'll come back to this later in this talk. If you're resident, you don't necessarily are a tax resident if you are on a short working trip or short working visa. So what we have seen post-Brexit is that EU citizens traveling on short business and family trips outside the EU, including now the UK, including Gibraltar, as well as the non-Schengen zone countries like Ireland, Romania, Croatia, and Cyprus, have to use your passport to get into those countries. So those type of short-term business trips now for EU citizens into the UK require a passport, and for UK people traveling into the EU require a passport because they're no longer in the Schengen zone. Doesn't make a big difference for the UK. UK was never in the Schengen zone. Ireland has no intention of going in the Schengen zone at this point, whereas the other EU countries not in the Schengen zone are looking to join at some point in the future, and possibly the start of 2023. So you can take up residence in a short-term basis, possibly even working short-term or long-term holiday home or family home. All these things are possible. For expats without a visa, and that residence, that short-term residence up to 180 days, doesn't necessarily mean that you're a tax resident. So it doesn't that you spend 180 days a year in the UK, a resident without the Schengen zone restrictions, doesn't mean that you become a tax resident, doesn't mean that you need to do a tax return, but you could. Just because you're non-resident doesn't mean that you haven't got an obligation to tax either. So all these things are what we're looking at here in this series of residents and non-residents, and that issue, it doesn't determine whether you need a UK tax return. Now, UK citizens, UK domiciled persons, expats that are tax residents in the UK are much more likely to have to do a UK tax return than anybody else. Even so, that liability may arise. Okay, the very basic rule on whether you need a UK tax return is very, very simple. If the UK tax authorities, HMRC, His Majesty's Revenue and Collection Service, requires you by letter or notice to submit a return, then you must submit a return. If you have a tax liability in the UK, then it is your responsibility to report that and pay that tax. So if you have receive income but don't bother to do that tax return as a resident or non-resident, an expat or a UK citizen, and you receive income but don't report it to the tax authority, that's either called discrete tax planning or it's called tax evasion, and potentially it's illegal. But either way, if through exchange of information between banks and property rental agents, investment companies, and overseas tax authorities, if that exchange of information subsequently that happens comes back on your door, then potentially the revenue can check up. And one of the benefits of technology is that the governments can find you out. So it's important to be clear and be correct in what you're doing. Okay, so whatever your residency or not residency, you could have a liability to do that tax return, and that's something that we need to look at in what we're doing. And what it determines is what type of income that you've got. So let's consider where the tax rules come from. Each country is different, but they're all the same in a way. There is, we are led to believe, an international organization of global bodies that organize how things go. And there is a general format of a double taxation treaty between countries. There has to be a double taxation treaty between your country of tax residence and your country of citizenship, domicile, or where the income is arising, for that to apply. Generically, the double taxation treaties are the same, but individually, there are significant differences for each jurisdiction. And those are the individual issues and identities that pick up for expats with cross-border business, property investment, and lifestyle incomes. And that's why you can contact us at proactpartnership.com. We offer free reviews to new inquiries and existing inquiries, but we've also got a retained client service which offers online consultant reviews on a regular basis to keep your tax returns up to date. Subscribe at our YouTube channel below to stay in touch with more data going forward. So the Double Taxation Treaty Charters generally describes and defines the different types of income and where they're taxable in your home country or where the country that it arises, depending upon whatever that income or gains contract is being executed. And that defines essentially the two types of taxable gain or income, that it is movable or it's immovable, is fixed or it moves. When you go expat, some of your worldly income travels with you. So wherever you are tax resident, that is where the income is being earned. So if you have interest arising or royalties being paid or dividends being received, they are all taxable in the country in which the individual or the company is tax resident. There's also fixed types of income. Fixed incomes are taxable in the country, in the jurisdiction in which they arise. So for a lot of expats with property investments and using it for short or long-term holiday lets, those property contracts are literally fixed. The building is fixed in that country. That income arising there is taxable there. If you're carrying out a contract in a country, it could be taxable in that country. So if the economic activity is undertaken in that country, then it is taxable in the country where the economic activity is taking place. So it's fixed in that respect, but it also can be movable. So this is something that we need to consider. If you're working remotely, it then comes down to what your contract is, how you're working, what your residency status is, and your non-residency status and your tax status. And all those are the things that we need to put into the mix and consider. Okay, so for the UK tax return, let's consider the different criteria, the different types of income and gains to determine whether you need a tax return as an expat, post-Brexit, living in the UK or living outside the UK. And we're not talking about if you're resident or non-resident. We're saying that this is for any type of income that comes up, whether you're resident or non-resident to the UK. Do you need to do a tax return for this piece of income? Okay, so if you're operating a UK business and you've got either as a sole trader, a partner, or that you've got a directorship, then that gives you a liability to do a tax return. So if you're operating a UK company and you're a director of that company, that gives you a requirement to fill out a UK tax return. Okay, so it's an important point to consider there. If you're an off-payroll worker, if you're being paid a fee for doing your work to settle your own tax, then again, those off-payroll workers may be subject to IR35 rules, and you may also have a reporting requirement for that income. So the IR35 rules are up in the air at the moment because the UK have got a set of rules. It was going to be withdrawn, and now the map is being redrawn. But essentially, an employer in the UK of an off-payroll worker that might be working remotely in the EU, they could do that, but that remote worker could fall under certain circumstances into a taxable situation where the company is liable to pay payroll tax, pay as you earn under IR35 rules. Okay. Conversely, if the contractor to the UK company is carrying out the economic activity in another country where they are tax resident, then they have to be registered for that. And if they're carrying that work out as an employee in another country, the company has to have a branch in that other country. So the contractor either needs to be registered as a self-employed trader in the UK or another tax jurisdiction, or there has to be a branch of the company for them to employ and pay national insurance in that other second jurisdiction. But the third consideration is that certain companies and contracts will fall under IR35 rules anyway, whatever the circumstance. So business income are a big source of potential liability to do a tax return. If you're a director, a self-employed, a partner, or doing off-payroll work in the UK, even if you're doing that as a non-resident, you've got a liability to do a tax return. And if you need help to complete that tax return, contact us at proactpartnership.com. Another type of income that expats often have is linked to property. Property, long-term rental and short-term rental is often a passive sort of income that expats and investors have in the UK and around the world. Property income generally in any jurisdiction is taxable in the country in which it arises. Now, in the past, that may not have been enforced, but property agents around the world under international tax regulations are generally obliged to report that income now to the tax authorities, and as everybody understands who the beneficial owners of companies, property, and trust income by the beneficial owner registers, the exchange of information allows a local tax authority to identify who is receiving what income and when. And so with property income, in the past, someone may have owned a villa in Spain and got holiday lets for cash, not paid a tax, but that may well change going forward. There may be a withholding tax in the local jurisdiction, even so, but as far as the UK is concerned, if there's UK property rental going in, then potentially there's a tax return liability that's due. Okay, if you're an expat and you own property rental in the UK, even if you're tax resident in another jurisdiction, you've got a tax return liability to due in the UK, and obviously it's an assessment for tax. You may have tax to pay. There are exemptions with property. If your net income after expenses is below £2,500, assuming that your gross turnover was less than 10,000, then you don't need to do a tax return. So essentially, if your rental income is more than 800 a month, you always have to do a tax return. If your rental income is below that, and your net income is above 2,500, you always have to do a tax return. It's only if you've got a very small income, less than 2,500 from property rental, have you got no reporting on that property rental income, unless of course you've got other income. But in isolation, an expat who owns a UK property rental income that meets the criteria may not need to do a return. Okay, somebody that's living and working in the UK with property rental income in the UK would have to report it along with their other income and allowances. If an expat in the UK has got income from overseas from property, that property income overseas will be taxed overseas, but it still could be reportable in the UK and offset against the tax that's paid abroad. So you may still, as a UK tax resident expat, be liable to pay tax in the UK when you report it, because you're paying a higher rate of tax than you would do on that overseas income. Exchange of information will be reported between the jurisdiction in which the property rental income is received and reported and the jurisdiction of the beneficial owner. So the property is its own individual tax stamp and number. The beneficial owner of that property has got their tax number, and the recipient of the income, be that a company or an individual, have got their own tax number. And that exchange of information will take place over a couple of years to catch up with you. For more information and guidance on that, contact us at productpartnership.com. If you're a business and or you've got some individual licenses you've got outstanding, you may be receiving royalty income. Royalty income is a movable income. It's not a fixed income. So royalty income moves with you. So if you've got a licensed services and businesses that you've let out to people and businesses around you for your products and services, those royalties are movable income, taxable wherever you become tax resident. So if a business owner has got a number of brands and assets that are licensed and subcontracted, he could be living as an expat overseas and receiving royalty income rather than anything else to maximise that's taxed in that overseas jurisdiction. So a royalty received from the UK under a contract is taxed where the individual or company recipient of that royalty income is taxable. That makes sense. So when you receive that income is taxable in the country where the recipient, the beneficial owner, lives. Okay. For more information and guidance on using royalties to create movable income for cross-border business and family expat associations, contact us at productpartnership.com and subscribe to the YouTube channel to find out a bit more as well. We're talking about all the different sorts of incomes, but sometimes there's a passive financial income that comes from banks, investments that are owned. A lot of people invest in pensions. A lot of people invest in unit trusts, investment trusts, pensions, in unit trusts, investment trusts. They're all trusts. They're all a version of a trust. They all have a slightly different regulation. And trust apparently is quite a complicated area. And the reason that in the past it's been a very, very contentious area is because it allows people to be discreet and not pay taxes or a fair amount of tax on their income. That's not the purpose of trust. The purpose of trust is to protect family and business capital assets from the cost and delay of probate, a succession, or a bankruptcy, or a multiple inheritance where you want to keep the family business as one, but have 5 or 6 beneficiaries. That the trust allows you to do that. So it's well worth considering using a family trust to protect your family property and business assets and avoid the cost of delay of probate. Potentially avoid inheritance tax liabilities, because with the trust there's no probate, there's no inheritance tax assessment. To avoid family disputes and conflicts, and hand the assets down the generations quite effectively. But with a trust, and in a trust, in a regime, in a world where the beneficial owners are clearly registered, and the trust is tax resident, then it also allows a way to provide a source of income. So you can go to a professional investment company, pension company, to provide that arrangement, or you can inherit it from the family and be the recipient of income that way, or you can create your own family trust to organise your family's assets and wealth. That might be a big yacht in a harbour in the Mediterranean. It might be your overseas properties. It might be your business in the UK. Either way, a family trust can help protect you down the line in a number of different ways. So consider that. If you get trust income, it is reportable, and depending upon the type, you need to consider that. But if the income is below 10,000, you don't need to do a tax return. So if you've got a small income, if you're an expat and your UK assets are in the UK on a UK trust, and the income that you receive is less than 10,000, as an individual, that's not a reportable tax return. Now, again, you may have other interests, and if you do have to do a tax return, you would put that on the return. But if that is your sole source of income, interest, dividends, income distributions from a family trust or a professional investment unit trust, then the income needs to be above 10,000 for you to be required to do HMRC tax return. For more information and guidance, contact us at proactpartnership.com. And to protect your family and business from 40% UK inheritance tax by using a family trust, contact us at proactpartnership.com. Once a family gifts property into a trust, it's potentially going to be exempt from inheritance tax indefinitely. So contact us for more information on that. There's what we're talking about as well is we're talking about income. So when is an income or a gain a foreign income or a foreign gain? Okay, well, it's when it comes from another country. So again, we're looking at residents and non-residents. So whether you're in the UK or outside the UK. So as far as the UK tax return is concerned, foreign income is capital, interest or earnings made and reported on an overseas tax return. So if you're in the UK and you've got an investment overseas, like a property or a business, and that you're receiving income from that, and it's being taxed at source for your overseas property rental income, that's reportable in the foreign income section of your tax return. And so obviously that's quite a significant complication to any tax return, and it's one of the areas that ProAct can help you with your UK tax return. So again, contact us at proactpartnership.com for more information and guidance on that, and we'll be able to help you choose that. We've got an annual tax service that offers you your tax return and year-round guidance for expats and business and family to protect their assets, answer their questions, deal with the correspondence, the assessment, and the how-to. So you've got peace of mind with our annual tax service. The ProAct Retain Client Service offers clients a way of getting access to online advice as you go along. So again, contact us at proactpartnership.com for more information and guidance. So if you have got foreign earnings, then they need to be reported on a tax return. This is for If you've got foreign earnings, you need to report it on a UK tax return if you are UK tax resident. Okay. So if you're resident and tax resident in the UK, that foreign earnings is reportable in the UK, and it's reported as a supplementary report to your basic tax return. Contact us at proactpartnership.com for more information and guidance. There are many other reasons why you might need to do a UK tax return. One of them is if you're receiving benefits or personal allowances and what have you. For an expat living and working abroad, this is broadly irrelevant. As soon as you leave the UK, benefits and entitlement to benefits and NHS cover cease. If you're working in the UK, any employment in the UK, you're liable to pay national health insurance. Doesn't mean you necessarily need to do a tax return. But if you are working as a remote worker, or you're working as a nomad, where you're moving throughout the EU, 3 months in one country, 3 months in another, to stay within the Schengen zone rules, and not spending more than 6 months being resident in a country for no more than 180 days, 6 months in any country during the year, your tax residence will remain somewhere else. So that's the key point that determines your liability to do that tax return and to do that economic activity. So if you're working as a nomad or as a remote worker and claiming that you've got a tax residence outside the UK, then you won't be entitled to the benefits that you might be receiving in the UK. If you continue to receive things like child benefit while you're an expat or living and working overseas as a family, that benefit payment will be reclaimed from you at some point when they find out and catch up with you. So generally, it's not really worth that. And you can also get, with expat families, you can get this, there's an issue around the residency permit, whether you've got settled or pre-settled status, whether you're a British citizen or not British citizen, whether you're UK domicile or not UK domicile. So if a married couple are not both UK domicile British citizens, and one of the family go to live and work abroad while the other one remains in the UK, then that could impact on child benefits for the family that remains in the UK and that income support. If you want any more help and guidance on the impact on family welfare benefits and healthcare when going expat from the UK or into the UK, contact us at proactpartnership.com. So I think we've covered that now, in my humble opinion. There's quicker ways to do it, to make that assessment. But what we're doing here is trying to go through the issues for that. If in doubt, do a return. If something happens in the UK where you get issued a pension, or you have a capital gain event, or you sell or buy a property, or you relocate overseas, or get a tax report from overseas, then you could be asked to do a tax return, even though you don't need to do one. If the UK tax authorities ask you to do a return, even if it's a nil return, then you must do that and wait for them to confirm that you no longer need to do a tax return. Some expats, we find, get big problems and end up with penalties from the UK, because the UK issue a notice to complete a tax return. The expats living and working abroad, the mail goes astray, nobody knows what's doing, they've never had a self-assessment liability, and it's only been issued because a pension company has paid an annuity of 2 and 6 from a long held job in the past. So these issues can arise. Don't worry about that. The penalties might roll up, and you get home and you find them there mounting up. again, that's manageable. HMRC are full of humans and they do make mistakes. The automated systems are not perfect. They churn out the mail, they churn out the fines to scare people into making a compliance. It's better to get the tax returns done on time, but if you find yourself in a penalty situation, it's better to tackle it as quickly as possible and manage that situation and manage that. And often we find that with full declaration and confirmation that there was no income or no real need to do that return, and the lifestyle of the expat would not normally have been warranted a tax return. Often those penalties are waived and reduced. So it's better to do the reporting and have the protection in place than take a risk and get yourself in a worrying, stressful situation where automatic fines are rapidly building up to you. For more information and guidance, contact us at proactpartnership.com. So, in our resident and series, and looking at the impact of Brexit on the UK, we find that remote working is more common post-COVID, post-Brexit, post-IT revolution. Remote working can work, and you can be resident without being tax resident, but you could be of a tax liability even if you're non-resident. For UK expats, if you domicile is the UK, that's your default tax authority, and you need a tax residence where you can declare your worldwide income. And if that's not your domicile, it needs to be a jurisdiction with a double taxation treaty between your country of domicile and your country of tax residence, and between where the country is arising. The income or the gain is arising. There needs to be a double taxation treaty as well. If the tax is paid in one country, it's not paid back home in the UK, but you still need to report it on the tax return. Keep everything together and correct. Keep all the information up to date. Have the reassurance of an annual service where you've got people available to support you, and you'll have peace of mind while living and working abroad, whether it's your family business or whether it's overseas property or just a lifestyle change away from the home country. Contact us at proactpartnership.com for more information and guidance and a free review to find out if you need to do a UK tax return. We're going to continue our residency series next week, where we're going to look a bit more about this distinction between when people need to do tax returns or not. So we're very much in the tax return season for the UK at the moment, and what we're going to have a deeper look into next week is the constitution of when a business income as a self-employed, a director, a partner, or an off-payroll worker, when that liability is taxable and reportable in the UK, and when it's not reportable in the UK, and what the impact of Brexit is on that in terms of EU remote working and cross-border within the EU. Thanks very much for listening, and we hope to see you again next time.